Hey everyone, my name is Sean Durr. I'm a real estate professional in Maryland for the past 15 years. I was a former financial planner, registered investment advisor, and CFO of a tech company. I'm also a husband and father of three. I want to share with you my knowledge of getting financially free, especially when it comes to your home. It's really important because the home is one of the most expensive, if not the most expensive item that you're ever going to purchase. And it really saddens me that the average homeowner stays in debt for over 30 years and even into retirement. We can do something about that if you want the help. And that's what I want to try to accomplish today. In this step by step tutorial, I will share with you my knowledge that has helped hundreds of people. And now it's your turn. Okay, let's get started. In today's agenda, we're going to do a step-by-step process that will show you how to pay off your mortgage in 5 to 7 years. Most scenarios is under 10. Most importantly, we're going to lower that effective interest rate by a lot and also lower the total interest payments paid by a lot. With that extra money, you'll be able to save for retirement, buy additional investment properties, possibly save for that college funds, and create generational wealth. And don't worry, you can utilize these strategies without modifying your loan, without changing your income, and also without hurting your credit. Finally, you won't have to make extra payments to your mortgage. Just one disclaimer, I am no longer a financial advisor, so please consult with your own financial professionals before implementing any of these strategies. Okay, let's look at this line graph here, which represents a 30-year mortgage. The horizontal line will represent the time from year 0 to year 30, and the vertical line will represent, let's say, a mortgage payment of $1,000. Over time, as you can see, your initial payments are really dedicated to the interest, which is indicated by the blue line, and the principal is indicated by the red line. So for the first 10 to 15 years, majority of your $1,000 payment is dedicated to interest and not principal. This is why we have such a huge balance after the end of 5 or even 10 years, and wondering how in the world did we not pay down this principal. And usually, people don't keep track of this until they buy or sell their home or refinance. So one of the things that we have to be aware of is that all that interest that you're paying in the first 10 years is what we call front-loaded interest. The bank gets their money first because your balance is really, really high and it's going down at a very slow rate. You really want to be in that section of the red, but we never really get there until the ending of the mortgage. So just keep in mind that when you do this and make these payments, majority of that interest is what we call front loaded. Now, what happens typically is that we all fall into two major traps when it comes to our mortgage. And it typically happens within 5 to 7 years. And why is that? Well, the average person will probably buy anywhere between 3 to 5 homes throughout their lifetime. Or you might be refinancing as rates go down. You'd be getting a rate today, in the sevens or eights. And then when it goes down to 5.5 or 6, you may pay to refinance. Or when it goes down to 3 or 4, you're going to refinance again because your lender is going to give you a call and show you how to save, $100, $200 a month. The problem with this is that when you buy another home or refinance, you can't start from where you left off. You have to start your 30-year cycle all over again. So you're never ever going to reach that area of principal in red because you're always starting the cycle. Therefore, you're constantly in that area of paying front load interest in those 5 to 7 years. And again, this is what puts people in debt for a very long time because every time they make a change, whether again it's buying a house or refinancing, the process starts all over again. And so by staying in this never ending cycle of debt throughout your life and even possibly through retirement, um, you're never going to get ahead. And we want to try to solve this by getting to the red zone and paying down that principal so that you don't have any more debt. You might be asking, well, what happens if I have a low interest rate mortgage right now. What do I do? Well, unless you're going to pay off early, it's the same thing because whether or not you realize it, you're probably going to buy another home before this low interest rate gets to majority of the principal. And when you buy that next home, you're going to be at the current market, which could be higher, most likely. And you're going to start again that process. So even if you're at a 3-4% rate today, it's still a majority of interest. And therefore, when you do it again, you're going to start the process all over. And what are we sacrificing by staying in debt? Well, we know pretty much what it probably is you're delaying saving that extra money towards retirement. Uh, College funds are not inexpensive anymore, and you're missing out on potential other investment opportunities. So if you had the ability to pay your house off in 5 to 7 years, you could do a lot of things with that extra money to be able to gain financial freedom and happiness. You don't want that stress to be never ending and stay with you your entire life. We have other things important in our life to keep track of: our family, friends, and other social things we do, your work. So if we could do one thing and pay down that home quicker, that would relieve a lot of the stress financially. And let's look, even if, let's say, you had a 5% loan, and we're going to just use $100,000 on this mortgage calculator. You can verify these numbers yourself. Um, at the end of 30 years, you've spent $93,000 plus that principal of 100,000. You're spending close to $200,000, which is double by staying in a 30-year mortgage at 5%. That's a lot of money that could have been saved there for college, or, like I said, retirement, or other investment opportunities. So again, just because you have a low rate doesn't mean you're not paying a lot of money. So what is the solution? Well, there is a product that we all know or may not know. It's called a home equity line of credit, or abbreviation HELOC. The difference between a typical mortgage and a HELOC is as follows. A mortgage is close-ended. What that basically means is that you make your payment, you can't change it. You can certainly add more to it, but you can't take the money back out once you put it in. It's already amortized. The payments are set for you for 30 years. And the interest is amortized or calculated on a monthly basis, which is typically that rate that you locked in for 30 years. And that will not change unless you constructively make an extra payment to lower the payment. Thereby, that will also speed up the mortgage payment process. Now, with a HELOC, it's an open-ended revolving line of credit. And with that, that means that when you pay money into it, you can also take money out, kind of like a credit card, but not with the credit card interest rates. And the interest is calculated daily. So whatever the balance is at the end of the day, that is the daily interest that you are being charged, not monthly, not quarterly, not yearly, daily. So let's take a look at an example here on how daily interest is calculated. $100,000 debt at 8% divided by 365 days would mean that your interest payment would be $21.91 per day. Now watch this. Let's say that you deposit $5,000 to lower that 100,000 down to $95,000. So now the daily balance is 95,000 multiplied by 8% divided by 365 days. Your interest payment is now $20.82, not $21.91. So let's say this again. If, let's say, you start at $100,000 on day one as an average balance, you will be charged $21.91. Let's say you deposit $5,000 from your income on day two. Now, from day two on, you'll be only charged for a $95,000 balance, which is $20.82 a day. So here's where it gets interesting. Let's say that after you've lowered that balance down to $95,000 and you don't have to pay any bills for 20 days, you essentially are taking advantage of the fact that you put in $5,000 of your income, your total income, into the lowering of the balance. So for the next 20 days, let's say as an example, you're only paying $20.82, not like the conventional mortgage where you'll be charged $21.91 every single day. And then let's say that on the day 22, you have $3,000 of expenses for whatever they are: groceries, gasoline, credit card bills, car bills, etc. and you have to make this payment to your credit card or whatever that total is of $3,000. And you do that on day 22. So now what will happen is that since you've taken money out, $3,000, your balance now goes from 95 to $98,000 being charged at 8%. So you are in fact now being charged on a daily basis of $21.47, but you're still not charged $21.91 as you would in a regular mortgage. So by now you probably have heard about this HELOC. What we do know is that with a regular HELOC, it's typically a second lien when you have equity, extra equity in your home, and a lot of people use it. They get anywhere between a $20,000 to $50,000 line of credit on their home to use for home upgrades, vacation cars, or anything that they like for an emergency. And as you know, it's an equity line, so as you pay it down, you can borrow again, pay it down, borrow again. What most people don't know is that there are first lien HELOCs that can be used to buy a new home. And with that, you can borrow up to 80 to 90% of the value of your home, meaning you put 10 to 20% down. And with that, now you have the ability to buy a new home with a HELOC with the advantages of being able to deposit your monies into it, withdraw monies as you need it, and thereby using this method, you will find that you're going to have your loan paid off a lot faster. What's really interesting about this first HELOC, a lot of banks that offer this product also have a checking account attached with it. It's typically called like a sweep account because as you deposit money, money sweeps in, lowers the mortgage balance, and as it sweeps out to be used to pay your expenses. So, as an example here, as you see, the checking account is attached to the HELOC as one. So, as you receive your direct deposits from your paycheck, it will automatically lower the balance of the HELOC and give you that advantage of lower interest payments for the period of time. And then when you need the money, you can use a debit card, you can use a checkbook or online banking to then pay your groceries, gas, and other expenses. And then that would increase the balance of the HELOC. But again, as long as we are in positive cash flow and you're using that extra money, you're going to be saving that money because your money is going to be working harder and smarter every single day. So, what are the questions and concerns that many people have? Well, why should I trust this? Number one question, banks have this product for the past 18 years. It's just that not many people know about it or use it. Um, as a former registered investment advisor and CFO, I've used the product and I've recommended it to my clients. And, it's funny, you'll see that the majority of clients that have already used this program have financial planners because it usually takes somebody, a professional such as that, to understand the math that goes into this. I mean, it's not complex, it's really simple math. It's just that we are programmed to think a certain way. And for buying a house, we think of using a 15 or 30-year mortgage, and whatever the rate is, that's what it is. We never really think about how we can use other products that the banks offered in our favor. You may say to yourself, well, I already have a low rate. Let's say it's 4%. Well, did you know that a 3% mortgage paying over 30 years costs you more than a 9% interest rate for 10 years? It's that time that kills you. It's not the rate. Another question that a lot of people ask me is, well, why can't I just make extra payments or use the biweekly mortgage program? A couple of reasons. One, you're just taking the little bit of extra cash that you have to pay for that extra mortgage, which requires discipline. And, to be honest, not many people have that discipline or can remember to make that payment. A lot of people put it off or procrastinate. But the biggest thing also is that when you put that a large amount of money into paying down your debt, with a mortgage, you can't get that money back out. The only way you can get that money back out is if you refinance, cash out, or sell your home. So the access is not there. So that's not, when you make your money and you have to pay expenses, even if your expenses were not due for 2 weeks, you can't pay a mortgage and then ask for them to give you some money back for those expenses. However, with a HELOC, you can pay all your income into that and then allow the interest rate payments to go down every single day until you need to pay bills and then use your HELOC to pay your bills. Some people also were concerned about the safety of HELOCs because back in the 2008 and 2012, sometimes banks would have frozen the HELOCs, and there was a lot of banking issues due to that real estate recession. Part of the reason is also because back then a lot of lenders were loaning 125% of the value of the homes to people, and they lowered the restrictions and credit scores for getting these loans, which really got them in trouble. After 2012, there was a new law called the Dodd-Frank, which protects homeowners, and now the home equity lines or the banks are required to give you a 60-day notice in the event that something is changing. So if something did drastically happen, you could always refinance to with a different bank. And if you had to get a regular mortgage, you still could. But again, the best thing to do is to utilize this program and stick with it. So again, to reiterate the benefits of the first lien HELOC, it beats inflation by using all your cash to reduce the debt versus letting that money that would normally sit in your checking or savings. Your money will now work harder and smarter for you. This will reduce your overall effective interest rate, probably below 4%. You're going to have your house paid off in 5 to 7 years. And with this tool, you'll be able to have complete access to your money 24/7. If you need to buy a car or college funds and you didn't have it there, instead of having it saved in a savings account, which might not even be there, you'll have it in your home because you've been doing it every single month, every single, twice a month or whatever your pay is. You can even use it to consolidate your debt because by doing this, you are effectively making your money work harder because every time you get paid, that's going to lower the total balance of all your debt. And then when you need it, you just pull what you need to pay for your household expenses. And again, with this extra money, you'll be able to save extra for retirement, investment properties, college funding, and obtain financial freedom and become debt free early. I want to take the time and provide some additional clarity using this strategy as your home being like a checking account or low interest credit card. We're programmed to accept 30-year mortgage payments, not realizing the harm that it's doing to us by keeping us in debt. With credit cards, we're fully aware of the high interest rates. And I sometimes call the 30-year mortgage like a silent credit card killer because that balance stays with you for 30 years or more. I mean, imagine, would you keep a large balance like on your credit card for 30 years? You wouldn't do that because you're programmed to know that the interest rates on credit cards are so high that every time you see your statement, you're inclined to make that payment and make as much of a payment to lower that interest because you don't want to pay that extra money. But with a house, you don't do that because even though you get a mortgage statement, you're not looking at how much of that interest or how much of that payment is going to interest and how much of that payment is going to principal. It's pretty much automatic. And, for most of us, we probably have that mortgage payment taken out of our checking account automatically. So you don't even think about the balance. And the only time you really think about the balance, it's when it's time to sell your house or when you refinance your house. And by then it's too late because you've wasted all those years of paying practically mostly interest and hardly touching the principal. Remember, we want to get into that red zone of paying more principal and less interest. Um, and another thing, when we want to buy something that's maybe on the expensive side, and you see that you have accumulated money in your checking or savings account, and you see that big screen TV and you want to buy it, you're probably more inclined to spend money when you see a lot of money in your checking or savings account. You tend to splurge, but you don't think about the fact that on the other side, you still have debt. So your net worth is still going to be including your assets and your debt. Because you're not doing anything to decrease that debt. So by buying all these extra things where that money could have been used to pay down the debt and increasing your net worth, you're spending more money. I don't want to say necessarily recklessly, but you know, we all do that. We all do that. I mean, when I see a lot of money in my checking or savings account, I'm more inclined to spend it. When I keep cash in my wallet, I'm more inclined to spend it. We all have money in our 401k, our investment plans, and we have complete access to it. But we don't go and spend that money because it requires an extra step for us to make that phone call or to log in and move that money into our checking account. So if we could maybe take a little bit more time to think about and say to ourselves, do we really need to buy this? Do we really need to spend the money here? Well, maybe if you saw your mortgage balance go down every single time you get paid, you're going to be excited. You're going to be, trying to get that thing down to to zero as fast as possible. And knowing is half the battle. It's almost like you're taking 3 steps forward, 1 step back, 3 steps forward, 1 step back. Income, income, expenses. And by doing that, you're always taking 2 steps forward. Um, so this is what I think, people should be doing to keeping track of their financing and increase their wealth. All right, so let's get some more information. I offer a free consultation. It usually lasts for 30 to 45 minutes. You can book an appointment through the link below in my description. Also, I'm going to give you access to my mortgage savings calculator, which allows you to plug in your exact scenario that you want. You can compare it with your existing mortgage. You can compare it with a new mortgage that you're shopping around for. You just enter in the dollar figure of the home, as well as the mortgage that you're applying for, and income and approximate household expenses. And it calculates it for you and will tell you how many years your mortgage will be paid off. That link is also below. My financial planning days, I used to say to my clients, a goal without a deadline is just a dream. So take action, do yourself and your family a favor, and take the time to get financially debt free. Your future self is going to thank you. Again, thank you for watching this video. If you want more information and a free consultation, you can click on my link in the description to book an appointment. You have access to my financial calculator at your convenience. That link is also below. Thank you, and I hope you found this information useful. Take care.